what do you see as the three main fundamentals that you look at when you are valuing a company and wanting to invest your money into these small cap companies?
Yeah, and that's a great point, because you shouldn't listen to what your mate tells you at the pub.
No.
Or the cab driver.
I've made that mistake. Cab drivers are smart.
It depends on how late it is. But the key things that we think about, and we think about it like a stool. You should always think about it like a stool. If a stool doesn't have three legs, it falls over. It's like investment. If it doesn't have the three things that you need, it falls over, don't buy it, right? You might speculate in it and put $10 that you're prepared to lose in. That's different to investing. Investing is creating long-term wealth that is sustainable, that you pass down to generations, and that is investing. We think about it like this: board and management. You look at the board and the management. You look at the board first, because the board appoint the management, the board pay the management, and the board hold management accountable to the strategy. And then you look at the management and you say, are they capable and able to run this business? Have they run businesses in the past where they have been truthful, executed on the strategy, and delivered for investors? People are vital, because the fish rots from the head. And if they're the culture and the people aren't right, don't invest. Then we look at the accounts. So we look at the accounts, the P&L, profit and loss, the balance sheet, and the cash flow. And we look at the accounts because the accounts have to be constructed in either a conservative or aggressive manner when we look at them, because you can, when you toss a coin, never falls on its edge. Right? It's heads or tails. They're either conservative or they're aggressive. We want to buy stocks that have got conservative accounts, where they have assets and land and buildings on balance sheet, where they have conservative assumptions about the asset values, where they convert a lot of cash to what we call the good guys, the shareholders. And so you want to look at the accounts and you want to understand them. And if that leg doesn't stand and the management are great, don't invest, because that's another vital leg. The third is, ultimately you've got to understand the industry. And part of that is, as humans, we all think we can understand everything. You've got to know your limitations, and you've got to look at the industry and you've got to understand, will this produce long-term, durable, sustainable cash flows? What are the volatilities that happen in that industry? What are the competitors like? What will happen in terms of pricing? And what are the things that I don't know? And I think it's really vital, because when you buy a share, and a lot of people will talk about what PE, let's use that for example. And a PE is what's called a price to earnings. So if you think about it like this, if the price is $1 and the company earns 10 cents a share worth of earnings, well then it's $1 divided by 10 cents. So the PE is 10. So the higher the PE, traditionally, the more expensive the stock is deemed to be. But if I think about it a different way, if I say to you, you're going to pay a PE of 10, that means that you think you understand what the industry will be like for the next 10 years. Because you're hoping that company makes 10 cents a year or more for the next 10 years for you to get your money back. So if you pay a PE of 20, you're saying, I think I know what the industry will look like in 20 years. So the higher the PE, the more expensive the stock is, the more you have to have a crystal ball and look to the industry and understand what it might be.
And try and predict where they're going to get their growth from, because their only way to reduce that is to make more profit, more earnings.
Correct. So they may grow earnings, and actually what you might find is that in 7 years you get your money back. But 7 years is still a long time. That's your child going from year 7 to year 12 and first year uni. Right?
That's a long time.
Scary time. This big to this big, you know. Still asking for money, but you know. But so what we try and do is, if you understand the nature of the industry and you look at the accounts and see whether the accounts reflect what you are seeing in the industry and the cash conversion and the management and the board are good, you've got three legs to your stool. The stool will stand. And then the last piece to the puzzle is, what is it worth? But we don't get to what is it worth unless the three legs exist. They're the three key points. And then we go, okay, thinking what we know about the industry, thinking about the management and the execution and the strategy and where they're going to take the business, what could this be worth and how do we value it?